Right, lads and ladies, let's get into it. Fair value gaps. So, what is a fair value gap? A fair value gap is essentially a gap between, it's a three candle formation. It's a gap where the bottom candle and the top candle have a gap in the middle. That gap is called an imbalance, and it just shows that there was insufficient buyers and sellers in the market at the same time. So let's look at the definition. Fair value gap is an inefficiency in the market where the prices moved too rapidly, leaving behind gaps or voids that have not been filled by both buyers and sellers, but both buy and sell orders in the market. These areas often become significant points of interest for institutional traders, and price typically revisits them to balance or rebalance the market. Okay, so what is an imbalance? A market imbalance occurs when the supply and demand dynamics are significantly skewed, often leading to rapid price movements in one direction. This usually happens when large institutional traders execute trades, leaving price inefficiencies that are likely to be filled in the future, typically formed between a large impulsive move where the price doesn't completely fill orders at the available bid or ask offers. These areas are expected to be revisited in the future. So when we're talking about fair value gaps, we have two types of fair value gap. We have a BISI, which is a bullish fair value gap, and then we have a SIBI, which is a bearish fair value gap. All it means, so BISI stands for buy side imbalance and sell side insufficiency, which means that there was a buy side imbalance, so the sellers didn't get sufficient time to place their orders. And then the same with the SIBI, there was a sell side imbalance and a buy side inefficiency, so the buyers didn't get the time that they needed to place those trades because price moved way too quick through the zone. Here's just a quick example. We're going to jump into the chart now and have a look, just so you can identify the difference between a BISI and a SIBI. And as always, I'll leave the link to the course down below so you can have a look at it. And when we're talking about fair value gaps, we also have an inversion fair value gap. So all an inversion fair value gap is a fair value gap that failed to hold. Simply put, a fair value gap that failed to hold. So if we just jump to whatever, Euro USD, I'm going to have a look at a few examples. A fair value gap that is noticeable across multiple higher time frames is always going to be more accurate and more valuable. So to say, look, if we have a fair value gap on a minute time frame, let's have a quick look here. Go back a little bit. Bearish fair value gap, bearish fair value gap, bearish fair value gap, completely wiped through. Bullish fair value gap, wiped through. So the fair value gap, just so you know what I'm talking about, we'll jump to a higher time frame, is this gap between the two candles. But before we jump to a higher time frame and show you, it's important to note that a higher time frame always holds higher power. So you can see the amount of fair value gaps that are being blown through here in a 1 minute. If we look on a daily, let's see how the fair value gaps get more respected. If we have an example, fair value gap respected reaction. This here is a fair value gap. Bullish fair value gap. Bang, bang, respected. Now, if we have any examples of bearish fair value gaps, here we go. Bang, bang, respected. So that's just quick, so you understand that higher time frame does hold higher power, and it's important that if you're not just taking a trade or an entry off of a fair value gap or an inversion fair value gap on a 1 minute time frame or a 5 minute time frame, because if it's not there on a 15, 30 hour, 4 hour time frame, odds are it's going to be broken through. Not always, but it's more reliable if it's on a higher time frame. Right, so let's have a quick look now and see where we can find a fair value gap. The top of this candle wick to the bottom of this candle's wick, that's our fair value gap right there. And then we have another one here as well. Bang, bang, fair value gap. You can see them. Once you know how to identify them, you'll never not be able to see them. Bang, bang. So it's a three candle formation. If you're taking notes, it's a three candle formation where the top of the first candle in a busy fair value gap, the top of the first candle and the bottom of the third candle, they're not connected. So they're not connected with a wick, something like all this price action here, top of this candle, bottom of this candle, they cross over with these two wicks here. But the top of this candle wick and the bottom of this candle's wick, they don't have any wick in between them. That leaves your imbalance. That means price didn't have a sufficient amount of time to place orders within this zone. So what happened was price opened, rallied up. Whoa, that's not the thing I wanted. Price opened up here. We rallied up. We never took any sell orders through here, so we had an imbalance. How do we know it's an imbalance? Because we have the gap. And now price came down, filled this imbalance, and then went on in its intended direction. It's important to note when we're talking about imbalances or when we're talking about the market in general, price will always only ever go after liquidity and imbalances. That's just how the price moves. It'll go after liquidity and it'll go after imbalances. Another one here. You can go for days. There's millions of them. Another one here. I want you to go through and try to identify as many fair value gaps as you can. Right, so there's a lot of bullish fair value gaps. Let's have a look and see if we can find some bearish ones. Right. Bottom. So in a busy, it's going to be the bottom of the first candle to, the top of the first candle and to the bottom of the third candle. And with a SIBI, which is your opposite, which is your bearish fair value gap, it's going to be the bottom of the first candle to the top of the third candle. So the bottom of the first candle to the top of the third candle, and you can see we just about get tapped in just there. If we keep going, did we get into this one here? No, not quite. But you see here we have another one. We might tap into it in the future. So mark it out. Now let's see the price ever tap into this zone and get a reaction off it. Fair value gap, tapped into the zone, and then rallied back down. And then what did we do? We came and we got a deeper retracement into this bullish fair value gap, and then rallied up. And if we jump down to a 4-hour, what date is this? 23rd November 23. Jump down to 4-hour and do that. And then if we can find it. So this is that fair value gap that we just marked up a minute ago on a daily time frame. So if we jump down to a lower time frame, this is a 4-hour, and see if we can. This is a massive zone. To take an order out of this zone, it's huge. So it doesn't really make any sense, because by the time, if you enter into the top of this zone, if you enter off of the open of this zone, you're already floating in 100 pips drawdown before it even breaks out of the zone. So then you have the question of, where do you put your fair value gap? Where'd you put your entry? Do you put it at the top of the zone, the middle of the zone, the bottom of the zone? But if you put it at the bottom, then you might risk being stopped out. You might risk being not entered into the trade. But if you put it at the top of the zone with your stop loss 50%, you might risk being tapped out. So then we can have a look at this. Here we have another fair value gap. Fine. Slightly smaller. But if we were to take this fair value gap and enter at the start or the open of this fair value gap, well, then that means that we are already saving ourselves 43 pips in drawdown. Or if we enter out the 50%, you're saving yourself 80 pips in drawdown. So it's important. That's what I mean. If you have a higher time frame fair value gap and you can drop to a lower time frame fair value gap, you can keep scaling down the way to make your entries more precise. And then it's the exact same with a bearish fair value gap. Now let's have a quick look at inversions. Have a look through your charts and mark them out yourself. It's pretty simple. it's pretty simple understanding of it, but it's kind of important that you know it as well. All right, let's have a look here now. Here we have a fair value gap. What does price do? Price comes through the fair value gap, and instead of getting a reaction, instead of us coming into this fair value gap and going and getting a reaction off it, we went straight through it, came back, retested, and then continued up. This fair value gap, this inversion fair value gap, excuse me, is a key entry to a reversal. So when we're looking at fair value gaps in general, we're looking at price to go extension, retracement, extension, retracement, extension, retracement, and so on. So say, for example, we got this was a massive move up here, and this is your fair value gap. Price came down, tapped into this fair value gap, and then got a reaction off it. But if price came down and didn't tap into that fair value gap like that, say we created a different fair value gap right here, and we're clearly in an uptrend. Why? Because you have your higher highs and your higher lows. If price was to do something like this, so it's beneath this, so it's no longer a fair value gap. Now it's an inversion fair value gap because you closed below it. So that's telling us that price may be reversing. And if it comes back and retests it, even better again. That's an extra bit of confirmation for it. Let's have another quick look for inversions. There's a very good indicator you can use, fair value gap inversion. And it'll pop on all of them. Let's go back to here. And it'll pop on. Here you have your inversion. And the way it works, it would give you your entry off of the close of the candle that inversed that fair value gap. So here we have your bullish fair value gap. Why is it a bullish fair value gap? Because you have your high and your low. So this is going to be your gap or your inefficiency. Price came and we bust through this low, telling us that this low, we didn't get a reaction off it. So that's indicating that the buying pressure is slowing down or halting completely. So once we get a close below this fair value gap, this candle closure, usually on a smaller time frame, is your entry. And then once you enter in, it will give out your targets. But another one you could use as well, just to help you identify your fair value gaps, click on the indicators. Oh, I don't think we have it here, do we? Inversion. Go to indicators, Lux Algo, and go FEG, and then go. Just to help you identify for yourself, excuse me, what the fair value gaps actually look like. And that's essentially, it's actually very easy. It's a very good confidence to use. A lot of people do use it, and I'd highly recommend using it. It's what I use personally. But that is fair value gaps. Fair value gaps is one of the main confluences that we will use when we are trading, especially when you're trading SMC, because it tells a story. It tells a story that the price moved too quick in one direction, so certain orders couldn't be filled. So it gives you a re-entry, or if you get an inverse fair value gap, well, then it gives you a indication that the price is going to reverse. So that's simple enough, quick enough video today. I hope that resonated. I hope it got through to you all. Any questions at all, as always, fire them away, and I will catch us in the next video.